Hi everyone, welcome to the Keystone Financial Services 2013 Federal Income Tax Update. My name is Josh Nelson. I'm a certified financial planner and I'm also the CEO and senior financial advisor here at Keystone Financial. We believe that true wealth encompasses more than money, but of course our job is to help you manage your wealth as effectively as possible. So let's get started. This may be the final year the Bush tax cuts remain in effect unless Congress acts to further extend them. This presentation summarizes the major federal income tax changes that are scheduled to take effect in 2013 if Congress allows the Bush tax cuts to expire. As you can see, we've got quite an agenda today, and we're going to do a quick flyover to make sure we hit all of the major points. As you can see, most tax rates go up in 2013 if the Bush tax cuts expire, but not all. You can see there's one there, the 15% tax bracket, that stays the same. However, the lowest income Americans, which are currently paying 10%, their rate will go up to 15%, and then the higher tax brackets go up anywhere between 3 to 4.5%. One thing to keep in mind is that the qualified dividend income that's currently taxed at long-term capital gains rates, that will now be taxed as higher ordinary income rates. The maximum rate on capital gains is scheduled to increase from 15 to 20%. Now keep in mind that's long-term capital gains, meaning that the asset needs to have been held for at least 1 year. Individual taxpayers in the 10 and 15% ordinary income tax brackets currently pay no tax on long-term capital gains, and these taxpayers are scheduled to be subject to a 10% long-term capital gain rate in 2013. If Congress fails to take action as the year-end approaches, investors should consider whether selling in 2012 could make more sense than waiting until 2013 or beyond. The issue here is that any assets held for longer than 1 year qualify for long-term capital gains rates, which, as we just saw, are scheduled to go up in 2013. The Bush tax cuts created the concept of qualified dividend income, which currently allows dividends for most stocks to be taxed at the taxpayer's long-term capital gain rate. And in addition, qualified dividend income earned by mutual funds and exchange-traded funds may be distributed to shareholders and treated as qualified dividend income by that shareholder. Prior to the Bush tax cuts, all dividend income was taxed as ordinary income. If Congress fails to extend these provisions, the qualified dividend income provisions will expire, and all dividends will once again be taxed as ordinary income. Most notably, taxpayers in the highest marginal income tax bracket, who currently pay the 15% rate on qualified dividend income, will be taxed at 39.6% for dividends received from the same issuer in 2013. Additionally, the 3.8% Medicare Contribution Tax will increase the effective rate of tax on dividend income for certain high-income taxpayers to as high as 43.4%. One strategy for business owners is declaring and paying a larger than normal dividend this year if they're a C corporation and if they have sufficient earnings and profits. This provision, which was enacted as part of the Patient Protection and Affordable Care Act, or sometimes referred to as Obamacare, is scheduled to take effect regardless of whether Congress extends the Bush tax cuts. For individuals, the 3.8% tax will be imposed on the lesser of the individual's net investment income or the amount by which the individual's modified adjusted gross income exceeds certain thresholds, which are $250,000 for married individuals filing jointly or $200,000 for unmarried individuals. So specifically, this is one of those that you don't want to have more income than these amounts. It's very important that you consult your tax advisor or financial planner to make sure that you're following all the strategies and taking advantage of all the tools that are available. Most itemized deductions, except deductions for medical and dental expenses, investment interest, and casualty and theft losses, will be reduced by the lesser of 3% of AGI above an inflation-adjusted threshold, or 80% of the amount of itemized deductions otherwise allowable. The inflation-adjusted threshold is approximately $174,000 in 2013 for all taxpayers except those married filing separately. Doing a tax projection for year 2012 before December 31st is the best way to determine if accelerating the payment of year 2013 into year 2012 provides significant tax savings. Accelerating certain itemized deductions in 2012 to avoid the limitation may trigger AMT liability in 2012. Again, taxpayers should consult with their tax advisor or financial planner to discuss the impact of this limitation and whether it may be advantageous to accelerate certain deductions to 2012. This one applies more to business and I'll go through this quickly, but taxpayers may currently elect to expense certain depreciable business assets in the year the assets are placed into service, rather than having to capitalize and depreciate that cost over time. Section 179 assets includes machinery, equipment, other tangible personal property, and computer software. Both the maximum allowable expense and the investment ceiling will decrease next year, as shown in the table. The change in law will both significantly decrease the dollar amount of Section 179 assets that may be expensed and cause the phase-out to be triggered at a lower threshold. Again, business owners may consider putting that into place in 2012 to take advantage of the tax benefit. The employee portion of the hospital insurance payroll tax will increase by 0.9% from 1.45 to 2.35% on wages over $250,000 for married taxpayers filing jointly and $200,000 for other taxpayers. The employer portion of this tax remains 1.45% of all wages. A higher income taxpayer's personal exemptions, currently $3,800 per exemption, will be phased out when AGI exceeds an inflation index threshold. The inflation-adjusted threshold is projected to be $261,650 for married taxpayers filing jointly and $174,450 for unmarried taxpayers. As part of the Affordable Care Act, the threshold for claiming the itemized medical and dental expense deduction is scheduled to increase from 7.5% to 10% of AGI. The 7.5% threshold will continue to apply through 2016 for taxpayers or spouses who are 65 and older. The standard deduction for married taxpayers filing jointly will decrease to 167% rather than the current 200% of the standard deduction for unmarried taxpayers, currently $5,950. In 2012 dollars, this would lower the standard deduction for joint filers from $11,900 to $9,900. This deduction will apply only to interest paid during the first 60 months in which interest payments are required, whereas no such time limitation applies under current law. The deduction will phase out over lower modified adjusted gross income amounts, which are projected to be $75,000 for joint returns and $50,000 for all other returns. This exclusion, which allows employees to exclude from income up to $5,250 of employer-provided educational assistance, is scheduled to expire. Heirs, estates, and qualified revocable trusts will no longer be able to take advantage of the $250,000 exclusion of gain from the sale of the decedent's principal residence. Maximum creditable expenses will decrease from $3,000 to $2,400 for one qualifying individual and from $6,000 to $4,800 for two or more individuals. The maximum credit will decrease from 35% to 30% of creditable expenses. The AGI-based reduction in the credit will begin at $10,000 rather than $15,000. With the child credit, the maximum credit will decrease from $1,000 to $500 per child and cannot be used to offset AMT liability. And finally, the Earned Income Tax Credit. The phase-out ranges for claiming the credit, which vary depending on the number of qualifying children, are scheduled to decrease for joint returns. Further, the credit will be reduced by the taxpayer's AMT liability. Questions? Of course. This issue is a hot button right now, with Congress feverishly debating the fiscal cliff over the next 4 weeks or so. So what I would recommend you do is just take this in as a flyover of the things that could change. And, of course, two things could happen. One of those would be that the Bush tax cuts expire, everything in this presentation comes true. I think the more likely thing that will happen is that some, possibly all of these things will be extended on for Congress to debate in the future. All right, that's it. Thank you for your time. Thank you for your continued business. And please don't hesitate to call us if you have any questions or would like to discuss your personal situation.